to make this introduction very short and sweet. Again, we're very thankful to have Mr. Bill Nasgovitz here to speak to all of you and present some of his findings that he's been working on and observing in his vast experience in this space. Just a quick background on Bill. He is the founder of Heartland Advisors, which is a premier value shop out of Milwaukee, Wisconsin, which manages 5 mutual funds and private accounts. He is also the lead manager of Heartland Small MicroCap Value Fund, which just celebrated its 32nd year. So, Bill, with that, please, the floor is yours. Thank you.
Almost knocked down the curtain here. Pleasure to be here, Bob. This is my first visit, and congratulations on a nice event here. Seems to be a family affair here with half your relatives putting this thing together. So nice job to all the crafts. I do have this, whatever it is, 20-page piece, and we're going to zip through it. We're talking about microcaps, opportunity in a passive world. And just a little background on ourselves here. As Bob mentioned, we are in Milwaukee. The firm is just celebrated, actually. It's celebrating its 34th year of all value. We've got a great team of 16 investment professionals with over 300 years of experience. We own the company. It's employee-owned. We think that's important these days as our competitors get bigger and bigger and hopefully more and more bureaucratic. We're a bit contrarian, and we do eat our own cooking, about $30-some million invested in our 5 funds. And long-term, we're all talking about long-term these days, if you're in micros and certainly in value. Long-term, 80% of our offerings have beaten their benchmark. We have one new product which is trying to catch up. Thought we'd start with a definition of microcap. There's Morningstar's definition. On the next page, you'll see micro is, to them, less than 1.3 billion. It wasn't so many years ago when that might have been mid, really, right? Things have really grown. There's been tremendous, and now they have I didn't even know they had a giant category. If you're over 90 billion, you're now a giant. So it's wild. By prospectus, that's our definition. We do stick in the lower end of small in the value fund. Median market cap, as I said, $300 million. So why invest in small micro-cap stocks, especially when we're in this runaway bull market here? Look at the S&P, all-time high, NASDAQ over 6,000. Interesting, just looking back, the bottom, anybody remember the bottom? March of 2009, very good. And what was the S&P at? 666. So we've tripled. A lot of stocks haven't participated, though. And we're going to wander into perhaps why here. Certainly the next page, in our view, this headwind, this phenomenal growth of passivity, passive investing, indexing, ETFs. And here you see a slide showing trillions of dollars moving into those products, trillions of dollars, and trillions of dollars being taken away from active investors. It's quite a trend. It's in our view, it is a mania. On the next page, an indexation mania. This is a bubble in our view. Here's a look at Vanguard, over $4 trillion in assets. For all I know, they'll probably be at $5 trillion. Let's put this in perspective. What's our GDP? 17 trillion? I think the top 4, you add up State Street and BlackRock is actually bigger. They're about GDP today. 16, 17 trillion dollars in assets, concentration of assets, most of it indexed. And we're not even talking about the closet indexers, people who invest, who say they're active, but they hug the index, right? You add that in, and the predominant style today is index investing. That's where the money has been going. That's where the performance has been, to the detriment of all the active investors in the crowd and in the world today. So what's the attraction? You can see that on the next page. We now have a price war in indexation. The S&P 500, we're down to 3 or 4 basis points. They advertise that all over the board, Wall Street Journal and where else. Liquidity, I put a question there. We'll see what happens there on liquidity. The top 4 guys own 1 billion shares of the most popular stock, the largest market cap, Apple. 1 billion shares, it trades 30 million shares a day. So whenever this reverses, and it will reverse someday, it'll be interesting to see how liquid some of these big cap stocks are. Low turnover, all this stuff, tax advantage on ETFs. Recent performance, the S&P 500 has beaten most active investors over the past 7 years since this historic low period of interest rates. If you look back, and you could ask us for the info, we'll give it to you. This has happened before. There have been 5-7-year cycles, active outperforming, then underperforming, then outperforming, then underperforming. It goes back 30 years. We'll be happy to send you that chart. Recent performance has been strong, and popularity, of course, the herding instinct, money just keeps going to where it's performed well. This does set up a number of distortions. I just caught the last panel. I think they were talking about the GDXJ, is that right? Some of the distortions taking place in the mining sector today. It's really unbelievable. We own a gold stock, it's profitable, no debt, cash. They're having a great year. And the stock, when they announced, when VanEck, I guess, announced that they're going to change the index and make it bigger, and therefore gravitate toward larger mining companies, and they're going to have to sell down some of their smaller stocks, the stock sold off 20%. 20%. And that was when gold was making a new high, so a recovery high. All sorts of distortions. Here's Apple. This is the most favorite stock, of course. It's pushing 4% of the index. It's not as wild as it was in 2000, but it's approaching that, and probably will get there, in my view, in 2017, meaning 5% of the index. Similar to the Four Horsemen. Remember that group back in 99, 2000? Those gigantic tech stocks, which were selling at 50, 100 times earnings or more. So Apple is not an expensive stock based on PE today. However, Mr. Cook has not grown the business in 3 years. So you'll see that line, right? The gold line heading downward. Earnings expectations, but they've got new products coming out. They've got a new phone coming out. Well, so does Samsung and others as well, the Chinese, so we'll see how it holds up. But that's how people invest today. Popularity leads to inflated valuations, limited return potential in our view eventually, and inordinate risk. Inordinate risk. Inordinate risk. And we think this is being set up big time in the S&P 500. You'll see the valuation page here using GAAP earnings, not adjusted earnings, but GAAP earnings. $94, up a little bit here in a year, which is nice to see. They just popped here in this quarter. But we are selling, let's call it $100. We are selling about 24, 25 times earnings. The historic average in the S&P is what? 16, 17, so we're at 50% premium. Of course, interest rates are low, but so is the earnings yield and the dividend yield today, with perhaps Yellen increasing rates by 0.5%. We'll see. Another distortion, they were talking about the Canadian market. This shows the Russell 3000 index, the gold, which is American, versus the global index, and you can see the foreign market has not been doing too much. So we started a international fund a couple years ago, hired a guy from the state of Ohio who was was responsible for $10 billion. So this is a small little fund, international fund, which is, it's amazing the values you can find internationally. You could find companies selling below net working capital. That means you get the rest of the assets for free. It's a classic Benjamin Graham value tenet. So this market really hasn't done much, and you can go all the way back into the early 2000s. Tremendous value in emerging markets and even perhaps in Europe as well. So that fund concentrates on SMID stocks that pay dividends. We hope to capitalize on that distortion when it reverts back to the mean. We'll see. Other distortions, we talked about concentrated ownership, and that means voting. I think it's dangerous. We'll see how it plays out. Inefficient allocation of capital. Last month, Dish, the big cable competitor, was put into the S&P 500. So what happened? Stock went up $2 billion that week, $2 billion. Is Dish that much better of a company because it went in the S&P 500? I guess the market must think so. To complicate things, the SEC next year is coming up with liquidity rules for mutual funds and ETFs. Liquidity rules. So some of you might be a small cap company. So Heartland, for example, we always measure liquidity on the value fund. We're in small and micro cap stocks, a barbell approach. But we want to know how liquid the portfolio is based on previous trading, so we measure that. The SEC rules, it looks like, are going to force all funds and perhaps ETFs too to measure liquidity on a 1 day, 3 day, 7 day, less than 7 days, what you can liquidate within 7 days. So liquid, not so liquid, illiquid, and then very illiquid. And if you hit 15% of illiquid, you're going to have to report that to the SEC on a monthly basis, and your board. So in our view, that's going to put more pressure on what sector? MicroCap stocks. So that's coming. That will be put into place late next year, so about 1.5 years from now. It's coming. I don't think the market, we've talked to brokers, this is news to them. It's probably going to put a lot of street research out of business, I'm guessing. There's probably going to be less coverage as this plays out. We'll see if the SEC moderates their stance here. If you have an interest, now would be a good time to be lobbying your congressman or those that might be in power in D.C. to see if we can mitigate some of those rules. Why 15%? Some bureaucrat in Washington decided 15% was the number. So what's going to change this? On the next page, a tipping point question. I think we're getting close. I don't know if we're there, but God, the way the market moves these days, whether it's France or the election, it's amazing. Zero interest rates, it is changed. The rates have been going up now for years, a couple of years on the short end. And actually, the yield curve is getting flat. That might pose some problems for the economy and the markets. We'll see. Moving more toward fiscal policy, Democrat, Republican, you name it, independent, are probably going to keep spending money like crazy, and probably, maybe we'll see, $1 trillion infrastructure. Deflation to inflation, there's definitely wage inflation out there. Bureaucracy to less regulation should be good for a lot of companies and specifically smaller ones. Uncertainty to increase confidence. We see that in the business confidence levels. We think that's a positive. A lot of this indexation has been, we believe, due to regulatory risk. If you're a fiduciary, hey, I can't go wrong. I'll just hire, Vanguard with their S&P 500 fund. Why do I need Heartland or anybody else on the active side? And the biggie, this was briefly discussed earlier, 35% tax rate going down to 15 or 20%. That'd be very bullish in our view for small microcap companies because they are not GE. What did GE pay in taxes last year? Nothing. Although they must sense a change. They just sold, I don't know if you caught that, they sold their 600-person tax and accounting department to Price Waterhouse. So I think they're gearing for a change. Maybe they'll have to pay 20% taxes. The top 50 companies in the S&P 500 pay about 20%. Top 50. A lot of them, and they, by the way, are over 50% of the S&P 500, the top 50. So the big play is in companies that pay 35%. I mentioned home builders earlier in the earlier session. There's a great little company that's grown from nothing, never had a loss, from zero in 2003. They'll do $1 billion this year. They have a 33% tax rate or 35% tax rate. They're going to benefit. So that could add $1 a share in earnings. We'll see. We'll see if it happens, but it could be a catalyst. Another event, a flash crash, that would not surprise me. It should not surprise you. It's going to happen in ETF lands. ETFs, in some cases, they might have 8 or 9% in one stock. And there might be duplicate holdings in other ETFs. And so when it turns, it's going to turn with vengeance. I didn't put this one down here, but I just thought of another possible catalyst here. How about prayer? Can we all bow our heads and moment of silence just say, this has got to turn? It's supposed to be a joke. Okay. Lastly, this is a real serious crowd. Bob, not coffee. They need a drink. Valuation. Valuation does matter. That's what I think is going to turn this. Take a look at this page. Folks, this is craziness. We're talking about record profit margins for these companies. As labor rates go up, minimum wage, you name it, they're not going to get much relief from the tax guys. This is a sure sign of topping formation, in my view. And sentiment could not be more negative. I love this one. The numbers are in. Actively managed mutual funds are a dodo bird, waiting for extinction. The death of active management. We had a client this past month come in and said, guys, I really don't need you active value guys because I can just buy the S&P 500 fund and I will not lose. This is so reminiscent of 99-2000. And there are others. I'm sure you might have one as well. So where does this leave us? The opportunity, I think, is huge. Fewer active managers. Northwestern Mutual, the nation's 6th largest insurance company. 100 and how many years, Paul? 60 years old. Managed over $250 billion. Several months ago, just fired all their active in-house people. They've always managed it's a small part of their portfolio. Why? Cut costs. We're going to buy the S&P 500 index fund after 160 years. Across the board, people are going out of business, so there's increased pricing inefficiencies when a stock goes in and out of indexes. This past week or so, the junior miners. So it's a huge opportunity for the enterprising investor. The entrepreneurial investor, as Benjamin Graham called it, takes a little work, takes a little time. It's time for fundamental research. So in summary, the big picture for small micro-cap stocks. Did I skip a page in terms of how well small micros have done? Did I fly by that one? I think I did. That's page 4. Over the long term, small micros do 2% better on average than the bigger caps. Our fund, for example, has a 12 net return since inception. But it's been a very tough 5, 6, 7 years. Historic outperformance from small stocks. The headwinds are pervasive passivity, increased SEC regulation. It's time to diversify, do something different, be a bit contrarian, don't run with the herd. In a slow economy, niche businesses, if the economy is growing 1, 2%, we can find companies that are growing at 5% or 10% or, Lord, maybe even 20%, they'll eventually get discovered. They'll either get taken private or the market will discover them, in my view. Fewer active managers, opportunity for more pricing inefficiencies. Valuations do matter. Here's an example of the long-term 10-year rolling chart, growth versus value. Value has been out of style. These things move in cycles as well. So this is very reminiscent of the bottom back in 99-2000. Coming off that bottom, we killed the indexes off, for the next several years, many years. So I think that's being set up. Where can you find value? They talked about Canada. We've ventured up to Canada. You can find companies, $600 million companies that supply the top 10 automakers in the world at 3-4 times enterprise value EBITDA. What? It's amazing. But it's not in the S&P 500, of course. So in our view, a disciplined, value-based, we have that barbell approach with small micro work. It's going to take time. It's going to take patience. But in the end, value will be recognized in our view. So thank you, and I'll entertain some questions.
So we have time for
one question?
1 or 2 questions.
Maybe none. No questions. Yeah, go ahead.
What do you think will be a catalyst that might shift
Well, I had a page there of about 6 or 7. What might be the catalyst for making people perhaps be a little bit more discerning in terms of what they are buying? We used an example here of an ETF. It's $40 billion. It would be it's equivalent to the value fund. It's our competitor, $40 billion in one ETF, 1,900 stocks, and it's selling at, I think the multiple's 45 times earnings. Valuation, in the end, they'll get so large, they'll get top-heavy, and they will implode, like we've seen happen in real estate. We've seen it in other markets, stock markets. I think it will happen. And look at that page.
So it seems like you've drawn some parallels between 2000 and now, and it seems like then people were more into stock picking in these big tech companies. Now it's passive investing and almost a more boring approach to investing. So what's different this time, and how do you think it'll play out that's different than what happened in 2002 when things keep crashing down?
Well, the question is, there are similarities to 2000, and certainly in terms of valuation. However, this increase in passivity is mega compared to 2000, no doubt about it. So, that is worrisome. Again, what will cause investors to revert to the mean, so to speak, and rethink? I keep coming back to valuation. That's what counts. That's what makes money over the long term. Yes?
Bill, I've been in the market since about 66, 67. My question to you is with the ETFs, if they're really starting to cap out, what will be the overall effect, whether it be a big stock, a small stock, or a microcap, on this thing clobbering us? And could it become?
You're talking about the question is, in the next bear market, perhaps led by passive instruments, ETFs, it will be a difficult period. I think we all have to recognize things just don't grow to the sky forever and ever. There will be a serious correction. Have we had a 10% correction in the past 9 years? I don't think so. A lot of micros, though, if you think back to 2015, we had and early 16, we had like a rolling 2 or 3 year severe 2 or 3 episode bear market in small micro. A lot of these stocks have gone through a bear market. You can think of the small gold miners, they're down 80, 90% from their highs. Now, if that isn't a bear market, I don't know what is. Gold peaked out 6 years ago, right? It's been a long time. I would suspect, don't hold me to this, that an industry like that is going to hold up a lot better than Tesla. $50 billion market cap on negative cash flows, no earnings. They're always going to earn money next year, though. You had a question.
I don't know if you can really get to a data point on this, but how much of the passive investing is fueled by kind of a 401k construct where people's money is being, channeled that way, whether people like it or not ultimately, versus more open-ended, choice-based investing?
Well, I think that's been a big part of this move. Again, coming off of a big, bad bear financial crisis, bear market, people step back and say, gee, I've got to go the safe route. Bond funds were the rage, and now it's been, the S&P 500. Fiduciaries have played a big role in that. People don't know what to do. Yeah, it's been a big part, and it's a worry. What's going to dislodge that? I think a nice big bear market will dislodge it. This is where all the money's going. 90% of flows are going this way. And if you think back through history, it's not new. It just didn't happen over the last month or two. It's been going on for years now. And just think about all these past trends where people just can't lose, and it just goes to an extreme, and then it implodes. I don't know exactly what the event will be, but it's going to come. Last question, I guess.
Bill,
Are there differences in leverage ratios? Margin debt is at a record high today. It's off the charts. As a percent, though, of market cap, it's not that alarming, however. The economy has grown and GDP, whatever, but it's up there, similar to previous market tops. If we had 99 in there, it'd be like about this, okay? Today being up here, but a peak. Well, thank you very much. I appreciate being here. Good luck.